As a professional real estate investor, you're probably already familiar with the cap rate. This simple formula allows you to calculate the fair market value of most commercial properties out there. But maybe the case that you are evaluating an offer and the cap rate for that property doesn't align with similar properties out there. Maybe because the lease, the tenants, or the property itself has certain unique characteristics. In that case, choosing a standard cap rate may lead you to overpay or miss out on a business opportunity. In this video, I'm going to show you a more accurate way to calculate the fair market value of a commercial property using discounted cash flows or present value. So if you don't want to miss out, keep watching. So now let's try to find how to calculate the present value of a commercial property. So the first time you have to know is the cap rate. It's not the same for all the properties. Even if you have similar properties on the same type, like industrial properties, even if you have it on the same location, maybe you have it in Center Dallas or in South Dallas, maybe you may say the cap rate because that property was sold 6 months ago and the cap rate for that property was 7%, then this property is also 7%. That's not always the case because the cap rate depends on many things like the age, the tenant, the leases, the location, many things. So maybe you have the same type of property, the same space, the same square footage, but you have different leases. Maybe you have one lease, maybe you have an industrial property with one lease, and that's a long-term lease. Maybe it's a 5 or 10 years lease. And maybe you have a similar property, another industrial property, but you have 10 leases instead of one. And those leases, instead of 5 years, are 1 year. So which property you think has the lower cap rate? Of course, the one with the less tenants and the more credit tenants. So that's why you cannot always use the cap rate to calculate the price of a property, especially when you are going to make an offer. You better calculate with the cash flows with this method. So present value can be used. This is a formula that you can not only use to value real estate. You can use it to value any kind of assets that produces income, okay? Like real estate, like stocks, bonds, or many things, maybe even machinery that you rented out. So let's get into the hard part. So you have this, the formula for the present value. What is the present value? Basically, what do you prefer? $1 today or $1 in 1 year? Of course, you will say $1 today. That's why the money has more value in the present than in the future. So that's why you have to calculate all the cash flows that you are having from a property. You have to calculate on the present in order to value the property, to make a good offer. So that is basically the present value. It's the summatory or the sum or all those cash flows. That means the rent and also means the resale value. If you purchase a property and you hold it for 5 years, then you have to calculate the cash flows for the rents on those 5 years and then the resale value at the 5th year. So basically, it's the summatory of all those periods, okay? And you have to choose a rate. This is very important because you are basically comparing this investment with other investments with similar risk, okay? That's the rate. So, for example, if the mortgage rates are asking for those type of properties, let's say industrial, mortgage rates for industrial properties in your market, the lenders are asking 7%, then you may charge more, you may try to find more than the mortgages because you have more risk. Otherwise, you better lend the money than purchase a property because the property has more risk than lending. So that's basically the rate. But you cannot ask too much rate. For example, you cannot ask more rates than the stocks, some kind of index, Standard Poor's or so, I don't know. You have to be between the mortgage and the stocks rates of returns. Okay, so basically you have this formula for the present value, and this is present value. This is the return rate, as I told you. The number of periods, holding period. If you are going to hold in for 5 years, then you have 5 periods. And then you have this other formula, because these are periods. Remember, those periods are usually the years. So at the end of the year, you calculate the NOI. The NOI, it's an income. At the end, at the sale of the property, you have to calculate another cash flow. That is the resale value. You have at the 5th year or the last year, you have the last rent, but you also have the resale value, the resale price. Okay, so you have to calculate the resale price at that moment. So you have the net operating income at that year, and you have to divide it with this number, RT. RT, it's R less G. R, as I told you, is the return rate that you will choose based on the risk of the investment. Okay, and the G is the long-term NOI growth. So basically, when you purchase a property, or maybe let's say you just build a new property, you just develop a new property, so those rents will grow more in the first years. In the last years of the property, it will stabilize, and maybe in the first years your NOI will grow 3% or 4%, but then on the last years, then you will grow 2%. Okay, so that's the long-term NOI growth. Okay, so that's how you calculate this resale value, and I'm gonna show you in an example in the next whiteboard. Try to understand how the present value works with an example. Join me. So here we have an example of a 5 million property. It's a listed property in your local market, and the seller is asking 5 million. So they have the NOI for the last year, and according to that NOI, the property is priced at a 7% cap rate. Okay, you only divide the NOI by the property value and you get the cap rate. Okay, so the holding period, we are analyzing this property, and we are going to analyze the cash flows to price the property exactly. So we are looking for a holding period of 5 years, okay, which is the term for the lease it actually have. So the lease has a rent increase for 3% on the term. So we are pretty sure at least the rent will increase that amount, so the NOI will increase 3% at least. Okay, so after 5 years, we know the rents on that same market grows at 2%. So after that lease, we have to raise the rent only 2%. Okay, and the rate of return, this is very important. The rate of return we are going to choose, it's a 10%. Why 10%? Because we know in this market the mortgages are around 6-7%. Then the bond are, let's say, 8%. Okay, so the stocks are 15% and over returns. So we are going to choose something in between. So we decide to choose 10% just to fit the risk. We don't have the same risk as the bond. We have more risk because this is real estate, but we don't have as much risk as the stocks. So 10%, it's acceptable. So the first thing we have to calculate is the NOIs. Okay, we have to calculate the NOIs for the holding period. So we already know the starting NOI, it's 350. Okay, so we are forecasting the NOI at the end of the first year will grow 3%. so that means 360K. The second year, it grows the same 3% or up to 371,000. Okay, in the same way, all the years up to 405,000 US dollars. Okay, so here we have all the 5 NOIs for each years on the holding period. So then we have to calculate the resale value or RIV. Okay, so the formula for the resale value, it's the NOI divided at the end of the period of the holding period or at the sale, divided by R less G. R, it's the rate of return we already choose with its 10%, and then the G is the 2% that the rents will grow after the holding period. Okay, so we go with this number, which is the last NOI, which is $405,000, and we divided by 10 less 2. Okay, 0.10 less 0.2. Okay, less, and we got just over 5,071,000. Okay, this is the value for the resale at the end of the holding period. We will sell the property a little bit more than 5 million. Okay, so we keep this number. Okay, once we have all the NOIs for the cash flows of the holding period and we have the resale value, the last thing we have to do is to calculate the present value. We bring the value of that cash flows to the present to know how much are we going to pay or we are going to offer for that property. Okay, so here we have the first year, we have 360,000. We divided by 1 plus 0.1, which is the rate of return we already choose. And we do the same with all the NOIs and with the resale value. Okay, for example, with the second year NOI, we have $371,000. You see here, and we divided by 1 plus 0.1, but squared. This time squared because it's this cash flow. It's in the second year. It's not in the first year like this one. And this, we repeat these things with all other cash flows. If it's in the third year, we elevate to the cube. Okay, and the same thing with the resale value, because the resale value it's at the 5th year. Okay, so same thing, we divide the resale value, this number we calculated, by 1 plus 0.10. Okay, and then we sum up all these numbers. We sum all these numbers for the first year, for the second, third, fourth, and 5th year, and also with the present value of the resale value. Okay, so the final number for the sum of the present value, it's 4.59 million. Okay, so that comes to be lower than the 5 million the seller is asking. So we know now that the property is highly priced. So we are going to offer just 4.6 million for this property, and we hope the seller accepts this offer. But that's the fair value for the property because we already calculated with the present value of the cash flows. In this video, I show you how to calculate the fair market value of a commercial property using the discounted cash flows or present value. What other methods do you know to calculate the value of a commercial property? Write it on the comments. Thank you for watching this video. If you like it, please give me a thumbs up. Really, it helps me a lot. And if you want to keep watching videos like this, hit the subscribe button. That way you will receive a notification every time I upload a new video. If you want to invest in commercial real estate, but maybe you don't have the time or the money to start in, you can join my exclusive investor club. My investors start investing from 20,000 US dollar, and the best of it, it's totally stress-free. I manage everything. You can join by clicking on the link on the description below, and that way you will receive an email every time I find an investment opportunity for you. Thank you for watching the full video. I see you on the next one. But before, I will leave you with two more videos here.